Let's continue to talk about reopening. Let's continue to talk about cyclical stocks, reopened stocks, epicenter stocks, however you want to characterize them, with our featured guest today, who's now calling for an even bigger S&P breakout, maybe sooner than some people had expected. Tom Lee is the head of research at Fundstrat Global Advisors. Welcome back. It's good to see you on this Friday.
Yeah, great to see you, Scott.
Big headline from you today, man, is the breakout implies S&P 4,300 in the first half of this year. Tell us why.
Yeah, I mean, the S&P did something really important yesterday. It broke to a new high after a period of consolidation. One thing we have to keep in mind, if you look at the last two periods of consolidation and breakout, you had almost an immediate 10% rally. So that gets us to 4,300. But if we think about where the market is today compared to the start of the year, there's a lot of reasons to be more optimistic. You know, the path of the disease seems to be coming under control faster. And I think Biden's speech last night was really comforting to me. We've got brand new leadership coming through Epicenter. These are under-owned names, and they have the potential to rally another 50, 60%, which could fuel this S&P move. And more importantly, I do think that VIX is giving us a pretty decent signal. And finally, I think that, you know, the average American is ready to resume their analog life, you know, leave this digital life behind. And that gives us a lot of surprise. And there's a huge relief package coming that's going to deliver a lot of money to make that happen. So I think that we should be pretty optimistic about markets. All
good points. And it's hard to disagree with you. And I think the move today in rates is directly related to what the president said last night about wanting all adults to be eligible by May 1st. Maybe that's sooner than some people had anticipated. So the reopen and the boom, if you will, could happen quicker than people thought, and thus rates are going to rise. But is that a problem if rates continue to rise and maybe even speed faster than some people are comfortable with?
Yeah, I mean, the bond market is, is important to watch. It's, something we need to be afraid of. The level of rates today is actually still quite low. And I think even compared to a year ago, anything under 2% still looks pretty good. But you're right. The bond market, I mean, last week taught us, we have to be a little fearful of the bond market. But for now, it's cooperating.
I mean, you don't seem to be fearful of it, though, if you think we've got 9% or so to go over the next 3 months.
Yes. And I think part of the reason is I think investors got really cautious the last couple of weeks. There is a lot of liquidity coming into the economy. Stocks aren't that expensive. I know people talk about PEs, but we have to keep in mind in 2011, people thought interest rates were at historic lows and they were silly and rates rallied further. I think equity risk premia has a lot of room to fall, which means PEs can go up. But more importantly, I think earnings surprise could be tremendous. I mean, there's a lot of pent-up demand. Companies have already told us how much they cut cost. Even in 2008, on 10% lower revenues, the cyclical sectors had 20% higher earnings. That's in 2008. In the last 12 months, companies have had a chance to reinvent themselves. I think we're going to be surprised by how much earnings are generated by the S&P.